The first one looks at retirement benefits that arise after ceasing to be a resident. Now, when a person is a member of a South African retirement fund, they've been living here, working here, contributing to a retirement fund, they then cease to be a resident. We saw that there's already an amendment that's become effective the 1st of March 2021 to say that if this person has not yet reached retirement age and they want to take their money out of a preservation fund or out of a retirement annuity fund, they can't do that for 3 years. They've got to show that they have remained a non-resident for an uninterrupted period of 3 years before they can access those benefits. Okay, so that's an amendment that's already come in terms of the 2020 amendments. Now they're re-looking at this to say, well, what happens if this person leaves the money in the retirement fund and then only looks at accessing that money much later on when the person has actually reached retirement age, or if the person dies before then and the benefit is paid out as a death benefit. Now, the thing is that if this person is no longer a resident at the time that this benefit is paid out, whether it be a retirement benefit or a death benefit, a non-resident, remember, is only taxed in South Africa on South African source income. Well, Section 92I deems that these retirement benefits would be from a South African source because the benefits are paid by a South African approved retirement fund. So it is South African source income. Potentially then, we could still tax it in South Africa even if it's received by a non-resident. However, remember that we do have to look at the provisions of double tax agreements, and South Africa has more than 80 double tax agreements that we've entered into with other countries around the world. So if this person has immigrated from South Africa to country X, let's call it, and now they're a resident of country X and they want to now take their retirement benefit. They've reached retirement age. They want to now be paid out their retirement benefit from, let's say, the South African Preservation Fund. Well, you look at the South African DTA, the DTA rather, between South Africa and country X. Pretty much all the tax treaties between South Africa and other countries provide that retirement benefits, because these are all modeled on the OECD Model Tax Convention, most of them are certainly, and they would typically provide that retirement benefits are taxed only in the country of residence. So if this person has now become a resident of country X, even though this is a retirement benefit paid out by a South African retirement fund, it is SA source. The DTA provides that actually we can't tax it in South Africa. It has to only be taxed in the country of residence. And so South Africa effectively forfeits then its taxing rights, its ability to tax that retirement benefit. That does seem a little bit counter-logical, considering that this person has contributed into this fund while they were working in South Africa. It's a South African fund. The chances are this person even got tax deductions for all their contributions into that fund. It does seem a little counter-logical that South Africa would now have to forfeit its right to be able to tax that benefit when it's paid out on the basis that the person is now a non-resident. So what they are proposing to do is to introduce into the legislation a kind of a retirement withdrawal tax that kicks in when this person ceases to be a resident. So they would say when the person ceases to be resident, whatever retirement fund interest exists at that point, what is the value of that retirement fund interest, the person is deemed to have withdrawn from the fund and then work out what the tax would be on that withdrawal benefit. Well, of course, we do have one problem, is that the person can't actually take that benefit for at least 3 years. That's the one issue. The other issue is the person might decide to leave that in the fund for even longer until they get to retirement age. But what they're doing is they're creating a tax liability at the point that the person ceases to be a resident. But they won't claim payment of that tax liability until the person actually takes the money out of the fund. On the basis of good tax policy, there must be the ability to pay. It's bad tax policy to levy tax when the person has no cash to actually pay the tax. So although there is a tax liability at the point that the person ceases to be a resident, in terms of the proposal, that would not be enforceable in terms of being collected until such time as the person actually takes the payout from the fund. So whether that payout happens in 3 years' time, or whether it happens only much later when the person takes the retirement benefit. But the point of the matter is that there is a liability due to be paid. When the person eventually retires, maybe 10 years later, and they take a retirement benefit from the fund, then this liability for this tax would become due and payable. If the person has an additional liability based on whatever the actual lump sum tax is, then there would be that additional amount based on the excess. But certainly this retirement withdrawal tax would become payable. So even though the double tax agreement says that the subsequent payment of the lump sum is taxed only in the country of residence, in the meantime, we've already established that there's a tax liability on this retirement withdrawal benefit, demarcated, as it were, at the time that the person ceases to be tax resident. Okay, so quite an interesting amendment coming through there to ensure that South Africa can still claim some tax on those retirement savings.